Hello and welcome to this week's edition of Wealth After Work, the show bringing you to and through your retirement. I'm your host, Kristen Oakley, and joining me today is Ralph Grasso. He is the president and founder of ASC Financial Group, and Taylor Munoz, senior financial advisor. We've got a great show for you today. The title of this episode is Don't Try This at Home. Everything you need to know about RMDs. We're gonna get into what this means for you in your retirement, because left unchecked, or if you get it wrong, it could cost you extra IRS penalties and more in taxes. Get it right, it gives you more control of your retirement income. So Ralph, Taylor, excited to have this conversation with you both. How are you today?
Very good, Kristen. Well. How you doing?
I'm doing well, thank you. Good. And I want to share a quick story with our viewers that sets up this conversation perfectly. I recently was having dinner with some dear friends of mine. The wife is 65, the husband is 70, and people always ask me what it's like to host these shows and be with you all, right? So they were asking me some questions and we were talking about it. And that inadvertently turned into them asking me questions about their financial situation, of course, right? Yeah, so in turn, I started asking them some questions because I knew they had been working with another advisor at a big corporate firm for many years. And because of their ages, one of the things I said is you're really going to need to start thinking about and planning for your RMDs. And they looked at me and said, what are those?
Like a deer in headlights.
Deer in the headlights, right? What is that? We've never heard this term. Our advisors never talked to us about these things. So jokingly, I have heard RMDs can stand for really mean and dastardly, or retirement mass destruction. That's not what they actually stand for. Why don't you share what they actually mean?
Sure. So we're talking about required minimum distribution. And if you've got an traditional IRA or traditional 401k at work or 403b, these are government-sponsored plans. And the government says, hey, these type of plans, they're not a tax avoidance, they're a tax deferral. You haven't paid any tax on the money you've put in, and you pay no tax while it's accumulating. Government says you're going to pay me on the back end. And if you haven't taken money out at a certain age, you're going to be forced to take money out. And that is called your required minimum distribution. And right now, that is at age 73. And here's what we need to understand right off the top with RMDs. Number one, when that money comes out and it's taxed at ordinary tax rates, all right?
Yep.
And so, for example, if I've got stock in my IRA, I've got to liquidate that stock. I lose the favorable capital gain tax I would have had if it wasn't in an IRA, because now it all comes out as ordinary income tax.
Yes.
So, okay, what does that mean to me? Well, it could push you into a higher tax bracket, number one. Number two, it could trigger increase in premiums on your Medicare, and it also can trigger Social Security taxation. So we've got to look at how that money is going to be in the big scope of things. How is that money going to be addressed? Here's another factor and point that I want to stress is that if you miss a required minimum distribution, well, it's probably the highest tax penalty in the IRS code. And the IRS will say, you're going to pay a 25% penalty for that missed RMD, and then obviously you owe the tax. So your RMD is $10,000 for the year. That penalty, $2,500 plus the taxes that you owe. So it's important to understand RMDs, how they're calculated. Hopefully, folks, in this show, we're going to make it as simple as possible, and you walk away with some great information.
Yes, and I think our viewers are probably going to say, this is why I don't want to try this at home, and I need the group of ASC Financial to help me, right? Because it can get very complicated. I think of how the rules have changed just within the last 5 years alone around RMDs. That penalty, by the way, used to be 50%, 50. How nice of them that they've lowered it to only
Isn't that
25,
nice
right?
of them?
Goodness gracious, we don't want anyone to pay a penalty. So that's why we're having this important conversation today. Taylor, why don't you share with our viewers how RMDs are calculated and what that calculation is actually based on?
Sure. Yeah. So for most people, the two most important factors to understand is that the IRS has a table, a life expectancy table that they reference, and you need to know your account balances in those tax deferred accounts as of December 31st of the prior year, and it's based off of your age. And so you start off at a certain percentage that you're required to pull out, whether you need it or not, per the IRS, per that expectancy table. It escalates every year, and it's always based off of the balances in those tax deferred accounts the December 31st of the prior year. So those are what most folks have to focus on. Then there's some other factors. If you have a spouse that's more than 10 years younger than you, there's another table that's referenced that can actually result in maybe a slightly lesser RMD. And then when it comes to an IRA being inherited, the beneficiary and who that is matters as well. Spouses that inherit an IRA from a spouse, they have more favorable tax treatment. Anyone else, including children, and that's a big area that we find a lot of folks that come in to see us don't understand. Children are treated the same as anyone else. They have a 10-year period of time where they must draw down the balance in that traditional or that tax deferred account and pay the full tax load back to the government. So. It used to be you had a lifetime to do that.
To stretch it out over your lifetime.
Stretch it out over your lifetime. Now you have 10 years. There's some out there proposing 5 years. There's some saying, why are we delaying this at all? The government we want your money the year that you die. And so right now it's a 10-year period, but folks have to understand that those rules could always change
Government
in the
loves
future.
to change the rules.
Yes, they do.
Yep.
The only one constant with them is change, right?
Yeah.
Exactly.
But it's so important. What you just mentioned, Taylor, is one of the biggest changes over the last 5 years when it comes to RMDs. And I think so many folks aren't aware of it, and it has to be planned for, because if not, the person inheriting that wealth could even have a more significant tax problem, because usually folks inheriting that kind of money are doing so during their highest peak earning years. And so that just complicates this tax problem. I know you have some examples, because you do this for folks day in and day out, right? Because I know it can be very complicated, and we're trying to break it down today, but this is the world you live in, and you stay on top of this for your clients so they never have to worry about missing an RMD or getting the calculation wrong. What story would you like to share?
Well, we had a couple that came in to see us not too long ago from Albrightsville area of the Pocono area where we serve. And before they became clients, we talked about what it looks like to have an income first approach in retirement, the importance of planning for RMDs and the tax implications of our money. And we actually found in the process that once they became a client and we started to look at these new strategies, that they had missed their RMD with their previous advisor the year before. So we actually helped them correct that problem, go through the process of requesting some leniency, with the IRS on any fees that they would have incurred or that penalty. And then we set it up on an automated basis moving forward, so they didn't have to worry about that RMD anymore.
Right.
Right. And we'll talk about some of the more of the pitfalls to avoid the next segment. But one of the big pitfalls that a lot of folks don't understand is that the first year you take your RMD, you have until April 1st of the following year, right? So if you turn 73 in 2025, you have until April 1st of 2026 to take that RMD. But even if you take that RMD in 2026, that's to satisfy this year's RMD, but it's realized as income in 2026. And then what happens? In 2026, you have to take your second RMD.
To count for that year.
Yeah.
Correct.
Yeah.
But then any year after your first, you have to take that RMD by December 31st. You no longer get that extension to the next year.
Right.
And so a lot of folks don't understand that double whammy effect where you're realizing all of that income. So if your RMD is $35,000 and you take a second RMD and it's close to that amount as well, you're going to have close to $70,000 of added income that year that could really make it difficult for your financial picture. So, so again, that's where when we do our retirement income analysis, we help folks forecast the impact of their RMD. We look at your tax exposure, and that's part of that RMD equation. We look at the risk that you're taking, the fees that you're paying, and ultimately, are you maximizing income? Are you getting enough of a return to offset those required distributions that you have to pull out of your account. So if you're sitting at home and you're wondering, geez, how am I positioned? Have I taken all this into account? We'd encourage you to call the number on the screen or scan the QR code and reach out to us so that we can get you this complimentary analysis that will help you assume control of your RMDs and your tax picture as you enter into retirement.
Very well said, Taylor. Ralph, thank you so much. To our viewers at home, that number to call to schedule your complimentary retirement income analysis is there for you on the bottom of your screen. Simply dial 844-918-4867. Or if you'd rather connect online, we've got you covered. Simply grab your smartphone. You can click that QR code in the bottom right-hand corner of your screen, and that will get you connected as well. Don't go anywhere. When we come back, we're going to be sharing with you the most common traps that folks fall into when they try to do their RMD calculations on their own. Stay with us to find out what those traps are and how you can avoid making them right after this.
When I was a little kid, my father, he was an insurance salesman, and he would have his briefcases and his suits and things like that. And when he would come home from work, I would always try to put my feet into his shoes, and then I'd get my briefcase and I would tell him, Dad, I'm ready to go to work with you. And then sure enough, here we are, almost 35 years later, and we're working together. Outside of high school, I did some college years, and so I did go back and got a degree out of college. And when I was looking for a job, I was thinking, there's eventually some time I would maybe work with my father or for my father, but I decided to start working in a bank. And what I didn't know is while I was working there, my father would come in, do some business, but he would listen to kind of how I'd be dealing with clients. And one of the biggest things that I noticed at that time was while I was working with my clients, I tended to have a large number of retirees who are my clients. And one of the things that I did is I always spent some time with them reviewing over their checkbooks, helping them balancing their statements. And I remember my branch manager would always get upset with me because of how much time I spent, but I continually led the branch month after month in referrals because they're all like, oh, you should go see my banker, Josiah. He was fantastic. And so after working at that bank for about 2 years, my father said, I think you'd be a great addition to the firm. And so in 2007, he had invited me to come work with him. And it's been one of the greatest decisions I've ever made.
Welcome back to Wealth After Work. I'm Kristen Oakley here with both Ralph and Taylor from ASC Financial Group, and we're so glad that you're joining us today. If you're just tuning in, we are talking all about RMDs, your required minimum distributions, how they need to be planned for ahead of time before you get to that age if possible. And there's so many ways that they can go wrong. And if you fall into some of these traps, you could not only have to pay the tax, obviously, but also additional IRS penalties, and that's what we want to help avoid for you. So I know it's time for us to discuss some of these common traps that we see folks fall into when they try to do their RMDs on their own. You mentioned this in the first segment, Taylor, but we need to just kind of, as we're going through this list, recap. Delaying your first RMD, because again, the rule states that for your very first one and your first one only, you can wait until April 1st of the year following the year you turn 73. Now, let's just pause and go, who knows that off the top of their head, right? April 1st of the year following the year I turned 73. Exactly. And then it's like some sick April Fool's joke, right? It's not even matching up with the tax day. But again, explain why that can be a trap that folks fall into if they choose to delay that first one.
Yeah, just because that first year, since you're allowed to delay to the next year to take it, a lot of folks assume, well, that will count towards my previous year's income, or it's satisfying my previous year's RMD, but it's considered income in the year that you take it. And so that second year, you take your first RMD, you still have to take your second RMD that year. And those two have a doubling effect where now you've realized all of that additional income that can, and as Ralph had mentioned earlier, that can push you into new tax bracket. It can trigger Medicare premiums, higher premiums. It can just have an overall negative impact on your tax picture in retirement.
For sure. There's a domino effect there that can come into play.
Yes.
Yeah. All right. Next trap on our list is often folks sometimes will take the RMD from the wrong account, or they take the wrong amount from the wrong account. Explain how that happens.
Yeah. So, when you have an IRA, you have a lot of flexibility in how you can take your RMD. if you have multiple IRAs or one IRA, you can choose to take the RMD all from one, or you can spread it out amongst others.
You can aggregate,
You can
right?
aggregate them
Yeah.
together. But if you have a 401k or a 403b or a TSP, those accounts require their own RMD to come individually off of those balances. And so we've worked with a lot of folks that, I took my RMD. Well, they may have taken one of them, but they didn't take the RMD out of one of those other accounts that required its own individual.
Yep.
And so when we do that retirement income analysis with folks and we go over their tax exposure and gaining control of that situation, that's where we help guide a lot of folks towards rolling those old employer accounts over to an IRA where they get that maximum control.
Correct.
They can dictate how much is withheld. They can determine where they pull that RMD from.
Yeah, it gives them more flexibility.
Exactly.
For sure. And it's so helpful when you have consolidated those accounts, because then it's less confusing of where you need to pull what from.
Good point.
Right?
Yes.
Because nothing is worse than if someone takes the right amount, but guess what? If you take it from the wrong account, then wham, you're hit with that 25%
There it
penalty
is.
again,
Exactly.
right? So
Exactly.
no mercy from the IRS on that, unfortunately.
Yep.
Okay, there's another trap for folks who are still working, because there is an exception that can come into play, but a lot of people misunderstand that. So talk about that.
Yeah, some folks think that if they're still working, they don't owe any RMD at all. If they're still working, they may be able to delay the RMD on their active retirement account with their employer. So if they have a 401k or 403b, they don't have to take an RMD out of that typically yet if they're still working. But if they have older retirement accounts, employer accounts, IRAs, they still have to take an RMD from those accounts. And so that can very easily result in a missed RMD if folks don't fully understand that there's that distinction between the two.
Right. Yeah. Not all accounts are created equal, and it depends on your individual situation, right?
Yeah,
Sure.
Exactly.
And then this is an interesting one, not earning enough to offset withdrawals. Explain that pitfall.
Yeah, and this is a big passion of ours. We're
That's right.
income first advisors, right? We believe that when you get to retirement, you now have to make that transition to income first, getting a maximum return from your interest and dividends, not just relying on growth. Now, with the RMD, whether you need the money or not, you have to take it out.
Right.
And if we're not positioned correctly, and if folks are still invested the same way in retirement that they were when they were preparing for retirement, and they're still very growth centric, if they're not getting enough of a return in those invested accounts and they're drawing their RMD out, that RMD may have may start chipping away at the balance of their principal prematurely. Or if you think about it, if the RMD is about 4% for the year, that's how much they have to pull out, and the market dips that year and we lose 10%, well, now they're down 14%. They're selling off parts of their portfolio to meet their RMD. When the market is down, they're having to sell more to get the same amount of income to come out and then pay the government their tax. And then it just, snowballs as we move forward. And it's just not a guarantee that you're going to get the return that you need to offset those withdrawals.
Right. And so then we have the whole complicated issue of inherited IRAs. And Ralph, I'd love for you to speak to this, because the account values and inherited IRA rules are different. They make RMDs even more complicated.
Right. So let's break it down. Spouse. Okay. A spouse has a choice. The spouse can inherit their deceased spouse's IRA, or they can roll it over into their own IRA. Why would they probably want to do that? Well, if they inherit the IRA, Taylor talked about the 10-year period. Now that spouse is subject to withdrawals over a 10-year period. But if they roll it into their own IRA, then they can continue to defer. They turn 73, they'll start taking out required minimum distributions. So it gives more flexibility to roll it over than it is to inherit it. However, the government says only a spouse can do that. Anyone else, i.e. children, they've got to take it out over that 10-year period. And it's a different calculation. It's a higher amount. And here's the thing, you will not liquidate that account if you do it over 10 years. So in the 10th year, wham, whatever that account balance is coming out. It must be liquidated over that 10-year period. And then the other thing we want to mention quickly is these accounts are transferred by beneficiary.
Yes.
And I think in one of our other shows, I had mentioned to you my clients, Jim and Mary in Blairstown, New Jersey. And so I want to refresh that story again in terms of beneficiary. You know, Jim came in and he had a substantial 401k, $1.5 million. And I asked him who his beneficiary was, because that's how it's transferred. He said his wife. I said, great. We called the 401k company to get more information. When we did, we find out, yeah, it was his wife. It was his first wife. Right. See, it was his ex-wife that he divorced like 10 years ago. He never changed the beneficiary. So beneficiary designations are key with these type of accounts, IRAs, 401ks, all right? And one of the things that we offer to those that are viewing us today is what we call our retirement income analysis. This is a customary, a complimentary rather, but custom report that's going to identify when tax rates or if tax rates go up, how's that going to affect my money? What are the fees that I'm paying? When the market has a downturn, how much of my money is exposed? And most importantly, am I maximizing income? And we can structure that as to how does that relate with my RMDs. So I'm going to encourage our viewers to pick up the phone and give us a call. Come in and meet with the team. Let us do this retirement income analysis, and let us take a deeper dive with you on these RMDs, these required minimum distributions.
Wonderful. Ralph Taylor, thank you so much. To our viewers at home, that number to call to schedule your complimentary retirement income analysis is 844-918-4867. Or again, if you want to connect online, simply scan that QR code and that will get you connected as well. When we come back, what happens if you don't necessarily need this RMD money to live off of? What are some strategies you can use to help potentially lower your tax liability? We'll tackle that when we come back.
A recent article shared the story of a 63-year-old planning on retiring early until the markets dropped. Watching years of hard work get impacted overnight caused him to rethink everything. It's a scenario more common than you may think. Volatility is a part of investing, but your retirement shouldn't hang in the balance. You need a strategy designed to weather storms, one that blends protection and growth. This can help keep your future on track, no matter what the headlines say.
Welcome back to Wealth After Work, where today we've been discussing RMDs, those required minimum distributions, and how to protect yourself from the potential pitfalls and traps that so many folks fall into when they try to do this on their own. That's why we always say, don't try this at home, right? This is something you specialize in doing. You do it routinely for your clients. You make sure that folks understand the rules and never miss one and get it right every single time. But, you know, some people that you all work with are blessed enough that they don't need that money to live off of, right? But it's a non-negotiable. It doesn't matter. Even if you don't need the money, you've got to take it and then pay the tax on it. So what are some strategies and what are some ways you're able to help folks navigate that tax problem?
It's a good question. So one of the things we do for our clients, if they don't need their RMD, is, well, let's reinvest it back in to an account, but an account that's going to be tax favored, right? And so we can do that and just have that money more like for savings and have it accumulate for them. Here's another thing that we've done with several of our clients that I think really makes a lot of sense. We can take that RMD and channel it into an insurance policy. Now, why an insurance policy? Well, today we've got insurance policies that will do multiple benefits. One, in the event of your death or when you die, it's going to pay out a tax-free death benefit. That tax-free death benefit can be used to pay the tax. So it kind of makes sense, the tax on the IRA or 401k. and we actually multiply the estate. But more than that, many of these insurance plans today have a second benefit, and that's if you need a long-term care confinement, they will pay benefits towards nursing home situation. So you're getting two benefits for the same dollar. And so that is something we can do for folks and look at channeling the RMDs into that. And then lastly, we can look at what's called a charitable remainder distribution, where the money, let's say I've been gifting to my church or to a charity, I can take my required minimum distribution and automatically have it go to whom I want it to go, as long as it's a 501c, it's qualified.
Right.
Now I pay no tax on that distribution because I get the deduction for the charity.
Yeah, and that's a win-win for everyone involved, right?
Absolutely. Great way to provide for your church or your charity and use your RMD in that fashion.
I'm curious, because going back to that story I shared at the beginning where this couple had been working with another financial advisor, but they had not even heard the term RMD, and I find that to be true for a lot of folks. How soon in the retirement planning process, when you meet with folks, is this something that comes up that you're discussing and planning and preparing for?
Well, certainly the earlier the better. And we often refer to something that's called the retirement red zone, right? It's that 5 to 10 years out from retirement. Really, at a minimum, that's when we should start having these discussions and planning for it. We can certainly do it when someone retires or they hit 65, but the more time, the more lead time that we have to address this, the better. You know, especially if, like, say, a Roth conversion is part of the picture where we haven't taken Social Security yet, our income's still a little low, we can take and start converting and taking monies out of the taxable accounts and converting towards tax-free with Roth. The earlier we can begin that process with folks, if it makes sense for them, the better, right? And then again, really that retirement income analysis that we talk so much about, that's our holistic 4-point strategy that we really want to lead folks through. And again, make sure that we've considered your tax exposure, which forecasts your RMDs, making sure that the risk you're taking is not prematurely lowering your accounts, looking at the fees you're paying so they're not eroding your principal prematurely, and making sure that you're maximizing your income to cover the RMDs that you're pulling out. So we encourage you to reach out to us at the number on the screen or the QR code below.
Wonderful. Thanks so much for watching. We'll see you next time here on Wealth After Work.